Hello and welcome to this programme from Baillie Gifford, the latest in a series where we talk to the fund managers of the group's different investment trusts. My name is Gavin Lumsden from Citywire, and today I'm speaking to Douglas Brodie, manager of Edinburgh Worldwide Investment Trust. Douglas is head of the global discovery team at Baillie Gifford. He joined the company in 2001 and became a partner in 2015. A CFA charter holder, he graduated with a BSc in molecular biology and biochemistry from the University of Durham in 1997 and attained a doctorate, a DPhil, in molecular immunology from the University of Oxford in 2001. Good morning, Douglas. Thanks very much for joining us.
Thank you, Gavin, and hello, everyone.
The past 3 years have been difficult, clearly, for the investment trust and your team's style in investing. So I was interested to read your commentary when you said to us, the prospect of robust returns is more attractive than at any time in recent memory. What makes you so confident?
Sure, yeah, happy to elaborate on that. So, as you say, a difficult 2 to 3 years in that post-pandemic washout phase, all the inflationary interest rate shocks, but really the enthusiasm that we allude to is rooted in what we seek to offer with the trust, which at its core is a portfolio built around understanding how the world is evolving, which companies we think are best positioned to drive and benefit from that change. To do that, we look for smaller businesses, those companies earlier in their life cycle, immature companies below the radar, companies which we think will benefit from that change and are out there really solving big problems, essentially aiming to access growth off a low base and retain special businesses as they grow and as they thrive and as they become successful. It's an approach that requires patience. It's all about the long-term building of businesses. These companies often start out in their early stages. They will be investing, they will be in their cash burning phases, and they will migrate to larger profit-making, cash-generative businesses. And our portfolio straddles both those worlds, from the early to the proven, and deliberately so. So in having exposure to that and exposure to private companies, we think we get that full sphere of all the innovation that's out there. It is undeniably a distinct style, but we think it's worth having exposure to that across all economic cycles. But in the current point, we have been very much out of favour. But to the point around enthusiasm, based on what we see, we think there are very, very valid grounds for thinking that we're through that point of maximum pessimism, frankly, in this current unusual cycle. And look, it's been one heck of a cocktail that investors have had to digest over these last few years. And we think that the core contributors to that are now dissipating. Inflation is clearly rolling over. The market seems to tie itself in knots around exactly when the rate environment will change. But these things are washing through. The tides are turning. And these pivot points tend to be amongst the most noisy, the most volatile periods. The clouds are lifting. And we, in the absence of any unexpected shocks, we think that creates an environment where investor time horizons normalize. Investors feel more comfortable projecting out. And I still think we're in the foothills of that. This remains a market that is acutely sort of near-term focused, but much of the real angst points we think are in the rearview mirror. And there's been this sort of growing disconnect, I would say, between how stock markets have treated companies, particularly smaller companies, and the actual fundamental progress of these companies. And when you combine that with this aggressive sort of valuation reset, we think that tees it up for a pretty pivotal moment with really the potential to shape long-term returns over the future. So being brave, being patient, that we think can unlock significant future rewards. And there's probably three things that I would keep coming back to that give us the enthusiasm. The technological progress that we've built the whole strategy around is very much alive and well. The holdings are by and large doing what we want them to do. There's 90 companies in the fund. So some will be doing better, some will be doing worse, but directionally, these businesses are doing what we want them to do. And valuations look attractive, and we think that presents a really interesting opportunity. And back that up by putting significant amounts of my own money into the fund over the past year as well.
So yes, you've got skin in the game. That's always reassuring to hear, I'm sure. It feels like the trust may be coming out of the storm, judging by the recent share price performance. Can I just ask you, what is encouraging you at a company and stock level?
Yeah, I'd probably build on that earlier point that the opportunity for innovation and progress is very much alive. Entrepreneurs, innovators that we see, they are building companies that are creating products and services that we think will genuinely surprise people on a 5, 10, 15-year view. Maybe the one that gets all the attention at the moment is generative AI. I'm sure your viewers are very familiar with aspects of that. There's clearly some direct beneficiaries of AI, the chip companies, the cloud companies, and there's almost a bit of a frenzy around that in stock markets. But it's pleasing to see many of our holdings using these AI capabilities to both expand their opportunity set, adding aspects to their competitive edge, and generally contributing to these companies' strong execution. I pick up companies like CyberArk in the cybersecurity area, a company we've owned for some time now called Appian, helping companies to use artificial intelligence to improve their business processes. Freelance agents like Upwork, the access to AI talent, the provision of tools to freelancers. So that's very much a live theme. Yeah, I'd stress that really the portfolio is exposed to multiple different themes, really exciting areas of innovation. Maybe to pick out a few, I mean, close to my own heart here is just how we're seeing researchers and clinicians understanding and exploiting DNA. And we have a significant portion of the fund exposed to this as a theme. So companies like Alnylam and Beam Therapeutics really exploiting genetic insights and making them therapeutically relevant and repeatable through new drugs and new platforms. A company like Twist Biosciences, the leader in writing DNA, Nanopore in terms of reading DNA with real precision. Companies like Billion to One and Exact Sciences and diagnostics and screening. So there's some real foundational tools that I think are very early in their potential uses. Another thing that we've become a bit more aware of, we're seeing incredible innovation in a wave of hardware and industrial type businesses, a sort of techno-industrial revolution, as it were. So companies using technologies and approaches to revolutionize physical processes, tackling industries, frankly, the way historically they've been relatively static. So relativity space, their advanced 3D printing capabilities. Companies like American Superconductor using superconducting materials and power management systems. Astranis redefining what's possible and the cost profile of geostationary satellites. Elsewhere, companies like Transmedics doing devices for organ perfusion, really radically transforming that transplantation market. So yeah, a whole swathe of enabling technologies, I think, really coming to the fore.
Fantastic. I wonder what lessons, Douglas, have you learnt from the downturn since the end of 2021, and how are those reflected in the portfolio?
Yeah, sure. I mean, you learn lots of lessons as you go, and we will get companies wrong. That's the nature of what we do, dabbling in early stage businesses. It's the reason why we run a diversified portfolio, frankly. But you don't come through a period like the last 3 or 4 years without genuine reflections on what you would have done differently, what you would have done better. I think in the past we've talked about some of the pressures we think that companies were placing themselves under in that era of sort of abundant capital, stock markets that were actively rewarding risk-taking. It possibly pushed some companies to have ambition that frankly ran ahead of their ability to execute. So be more questioning of companies, interrogate their actions, and what do their actions really signal. There is a clear requirement in what we do to be patient, but recognize the dangers of poor execution and be honest when that poor execution nullifies what might have been a great business opportunity. We've seen that recently with Teladoc, and arguably Wayfair was a little bit like that as well. I think we've recognized that we need to be more rigorous with enforcing risk-reward upside, especially when the risk-reward dynamics change very quickly, either through price appreciation or change in the backdrop. And this will always be a genuine challenge for a strategy like us, because we are looking for companies that can grow to be many times their initial size. But we've been deploying a sort of formal review process of companies which hit certain triggers, and we think that's adding a degree of rigor to what is undeniably a hard exercise, yet doing it a way that is still very true to our philosophy. So in the past, I think we've been good at critically sort of assessing valuation and upside and sell discipline in companies that have progressed far down that commercialization path. We've seen that with Tesla and Dexcom, two of our most successful investments, which we exited over the past 3 years, but bring some of that valuation rigor to companies early on that journey, tease out who can be special versus, maybe this is as good as it gets. And the upshot of that is we've weeded out some marginal ideas from the tail of the portfolio. We've capped some of our bigger, better performing names, positions such as Axon and Market Access, where we felt that the market was beginning to catch up with our view. And maybe just to quantify it a bit, we actually exited 15 names in the trust's year to the end of October 23, and about another 6 names since then.
Thank you. So there's still uncertainty, clearly, over the macroeconomic outlook and the direction for inflation and interest rates. Can you tell us about the work you and your colleagues have done around the financial sustainability of your holdings?
Yeah, I think from where we sit, it does feel like the big battle against inflation, frankly, has largely been won. I think there's a clear pattern in core CPI, and the next logical step is some kind of normalization, but a recognition that maybe the central banks will probably play that one with a little bit of caution. But almost regardless of that, we think there's compelling historical evidence to support the notion that returns from small and mid-cap indices, they tend to recover strongly in that 2 to 3 years following interest rate rises. If we look back at the last 6 cycles and look at the Russell 2000, which is the sort of US small and mid-cap market, it was up by an average of over 30% at that 3-year point the first interest rate rises. And we're rapidly approaching that sort of 2-year point for the current cycle. And the index is broadly flat. So for me, the historical lessons here are that the stock markets, they work through the issues that were challenging them in the short term, the things that tend to preoccupy them. But as your question suggests, companies, they need to survive these tougher times. And on that point, we think the EWIT portfolio is very well positioned, actually. Our private holdings in aggregate are very well capitalized, in some cases extremely well capitalized. The portfolio in aggregate is structured with about 60% of the fund in earnings positive, cash flow positive companies, 40% in pre-profit cash consumptive businesses. And of those latter ones, that the vast majority have really well proven commercial traction and robust cash positions to reach the milestones that we expect them to achieve. So, and where companies have needed money and the portfolio, we've seen them raise that. We've had QuantumScape raise money, Nanobiotics raise money, American Superconductor raise money. Lots of companies have operationally extended their cash runways. So to cut to the chase, we don't see funding as a material risk across the portfolio.
Okay, that's good to hear. So yes, share prices may take a knock, but the companies can get access to capital to grow their businesses. The launch of ChatGPT at the end of 22 generated obviously huge interest in artificial intelligence and underscored the importance of big tech, with the Magnificent Seven dominating US stock market returns since then. So I wonder, how does the success of the likes of mega caps such as Alphabet, Amazon, Meta, Nvidia, how do those affect your case for investing in smaller companies?
Yeah, sure. So look, these are very big, successful companies. They are dominant in their respective areas. But I think it's worth remembering that several of them were actually, they were the upstarts from not that long ago. So maybe to cut to the point of why they've been so strong recently, I think they're almost perceived as the digital utilities. They're all different businesses, but they've carved out, I think, a place of dominance. Their own part in their ecosystem of the market is clearly defined. And the market is very excited about where that positions them around artificial intelligence and all these local language models. These are the companies that own the data, they host the data, they process the data. They are the tangible infrastructure, frankly, for how individuals and businesses can engage with AI. And in some cases, that's reflected, I think, in that immediate growth. But almost when you step back from it, look at a technology like generative AI, it's ultimately interesting because of the new problems that will be solved with it. What can individuals or businesses now do that they couldn't do before? Well, what can be automated and what can be historically manual that can now be done in a very automated fashion? And the infrastructure of the cloud and the GPUs, it's required for that, but it's the tools, it's not necessarily the solutions. But I think at this early juncture, that's where the momentum is. So I'd expect that solutions opportunity to expand massively over the coming decade. And that's very much fair game for smaller businesses to be involved in that. I think it's almost analogous maybe to, if you draw back to the sort of the dot-com boom times, the moves in the likes of Cisco, Dell, Vodafone, yet the subsequent decade was all about what were the upstarts at the time, the Amazons, the Googles, the Facebooks, the Teslas, that all made use of that infrastructure built by the others. So yeah, it feels quite similar to me in terms of that. And I think that there's a history of the winners in any stock market area have a habit of redefining themselves each time, and there's changes in the backdrop, be it regulation, like the underlying technology architecture that these businesses are built on. You saw that with going from mainframes to PCs to cloud. You've seen it from CPUs to GPUs, and we suspect in time you will see it with quantum computing. So yeah, I think that there's always that risk, but the observation of there being big winners, that doesn't surprise me. Look, we are big believers in asymmetry, making multiple times your money, and these companies have lived that and they've breathed it. And that's great if you own them, and I genuinely hope many of you viewers have. But the only asymmetry with value is that could be unlocked, I think, by future returns. And to double, or more if you're a billion, 2 billion, trillion, 2 trillion, or 3 trillion market cap business, that's really hard. And where the ratings are, these companies will have to deliver that through genuine economic value creation. So that law of big numbers ultimately catches up with them, I think, eventually. But I think if you take that Magnificent Seven, the cumulative market cap across those is something like $13 trillion. If you look at our top 7 listed businesses in our portfolio, it's less than 0.5% of that. And we own some big successful companies. And I think that just tries to put it in a little bit of context. So yeah, asymmetry works when the base of which you have to grow is low. The market is inherently somehow skeptical around that. There's a mispricing, and the potential for outsized returns is vast. And none of that, to me, intuitively applies to the Magnificent Seven. And maybe one little teaser to put out there. I think, these are amongst the most analysed, most looked at businesses around there. And when you think about the price moves these businesses have had, and you try and link that back to anything around sort of efficient markets, just imagine how inefficient the equity analysis is when you come down the market cap scale, and the amount of eyes looking at businesses expands massively. So yeah, just maybe sort of put that one out there.
Yeah, Douglas, you mentioned you exited 15 stocks during the last financial year, and I think another 6 since then. So can we expect a more concentrated portfolio in future as you kind of double down looking for these phenomenal, rare companies?
Yeah, there's currently around 90 companies in the trust, and around 14 of those are private, and that's actually down quite markedly. I think we peaked at about 120 or so. The range that we quote is 75 to 125, so it may come down a little bit more, but we are in the sort of the lower range of where we operate. I think there's been a few factors driving that, some of which we've maybe touched on a little bit, but we have been recycling capital out of some of our maturing ideas, pushing that back into earlier stage companies. We've cleaned up the tail, moving on from ideas where we felt we'd given them, frankly, sufficient time, but maybe either the competitive dynamic had moved against them, the industry had moved against them. And that's generally freed up capital to deploy into ideas which we think the market is most obviously mispricing in that long-term sense. So companies where we think their relevance is increasing, but the market has derated them. And a common theme there would be around the punitive discounting of companies which are yet to be profitable. And that's not because they can't become profitable. It's just a reflection of their stage of development. They are perhaps early, they are subscale, they're investing in CapEx, R&D, etc. And with a long-term hat on that, that's the part of the market where we see the most potential for the returns to come from. And we think there's about 20% or so of the portfolio that will cross over to be cash flow generative, earnings generative in that sort of 1 to 3 year view as these companies mature and as they execute. And we think that's a sort of the wake-up call, frankly, for the stock market. I think you maybe touched on Nanopore and
yeah, I was going to ask you about. I mean, the portfolio is very skewed towards North America. About 3/4 of the assets there. I was just seeing on the fact sheet. So I always find it encouraging when there's some UK companies in there. Oxford Nanopore, you added to the holding during the year. What's going on there? What's the positive story?
Yeah, we've known this business for a good number of years now. It's actually the first private investment we did for the trust back in 2015. Listed in London, I think 2021. And frankly, that's been, as much as I'd like to sort of champion the home market, it has been a challenge for them. the UK market isn't always the most receptive home for ambitious, growth-orientated businesses, and I do have my frustrations with that. But that said, I do find the nanopore business fascinating, and I think it is misunderstood both by, I think, investors and by those, many of those in the sequencing community. So here is a technology that in real time can interrogate the universal code of life, and it can deliver rapid biologically relevant answers. It sees signals in DNA that other technologies miss. It can be used to understand genomes, see how dynamic those genomes are. It can answer specific questions, and it gives, I think, incredibly fast, actionable, clinically relevant data. And that could be in the transplantation setting for organ matching. It could be around infection and epidemiology. And I think in time it will be around cancer and oncology. So we do, we have the privilege in terms of what we do to see lots of profound technologies. And I must say, for me, nanopore sits right up there with some of the most interesting ones. And I guess it has had its challenges. It's been trying to commercialize that in a current sequencing opportunity that is, I think, somewhat static, frankly, and somewhat contained. And by that, I mean it's primarily a research, academic, customer-based. It's obsessed with quite I think, a narrow, risk-averse understanding of genomes. It's not particularly growthy, frankly, and you can almost see that in the growth profile of the gorilla in that area, which is Illumina. And breaking into that market structure, I think, has created some turbulence for nanopore. But just the opportunity in sequencing, for me, it's much more about moving away from this research setting into the clinic, getting this technology close to patients, close to where the insight is most relevant. And that's not about it being scientifically interesting. It's about a real world relevance of this. And with many diseases now having a clear link to genes and genetics and genetic regulation, I think the opportunity there is massive. And to do that, you need technologies deployable. You need low-cost sequencers, ones that are designed about yielding answers, not just massive gigabases of data. And that's where, for me, where the nanopore technology excels. And look, it has been a sort of, a difficult entry into markets for nanopore. I do kind of get that, but it hasn't escaped the gaze of the likes of bioMérieux, the multi-billion-dollar French diagnostics business, who actually took a almost 7% stake in the business last year, and talk about how this could transform aspects of infectious disease and treatment, areas they know very, very, very well.
Okay, interesting. Thank you, Douglas. I must ask you about SpaceX. At nearly 10% of assets, it's your biggest holding. What are you looking for from the company this year? After all, any positive developments, such as a flotation or an upwards revaluation, could have a big positive impact on the trust and its shares.
Yes, it's our largest position in the trust at the moment. I'm sure your viewers are very familiar with the rocket launch side of SpaceX, those sort of super cool videos of rockets landing, and it's probably, I'd guess you may be less familiar with just how dominant SpaceX has become in that rocket launch market, how it's hollowed out a really terrific position of being the lowest cost provider of putting cargo into orbit. And with the next generation Starship rocket coming along, it looks like they will further increase that lead, but perhaps into a sort of unassailable position. And this isn't just sort of low cost rocket launches for others. They are vertically integrating into that low Earth orbit satellite market with the Starlink technology. So that's the always on, go anywhere, high speed broadband connection. And that's allowed, I think, SpaceX to for a genuine claim to be the first global utility company. They've scaled that from a standing start just a few years ago to have, I think, now north of 2 million subscribers. That's what they've talked about towards the back end of last year, and growing at a really interesting rate. New terminals coming on offer faster and better speeds, and I think there's huge options really for how they evolve that Starlink business. They've talked about how you can now use it to extend the roaming range for mobile phones. You can have laser linkages between these satellites, so you can shuffle data faster than any other technology all around the world. It potentially does that allow you to locate your data centers in very low cost locations. Having that always on, always connected thing is interesting from a sort of Internet of Things. And I think you'll start to see probably maybe either private constellations for government or military use cases too. So yeah, terrific opportunity there, and potentially tens of millions, if not hundreds of millions of users in time for this technology, and new monetization routes will come as this opens up, as Starship comes on stream, cargo costs could become lower again. And I don't think it's hyperbole genuinely to think of SpaceX as a generation-defining investment. So yeah, delighted to have it as the biggest position. Explicitly, what we're sort of looking for over the next year, frankly, more of the same, but maybe with this critical density, giving them both options in the rocket side and the satellite side. It's a well-capitalized business. Elon has sort of mentioned how the Starlink business is already at a cash flow generative stage. Potentially that does give them options around how they evolve the business side of SpaceX. But there's no insights on us on the timing of that. Elon, frankly, will do that when it's good and ready, and rightly so.
I'm sure he will. I'm sure he will. Is there any other theme that has surprised you over the last 12 months? Perhaps the one that the market has not responded to?
Yeah, I guess a theme that we've been increasingly aware of is you're coming off the back of almost like a 20-year period where digital businesses and software businesses were almost the defining businesses of that time. They were the capital light, network effect, high scaling businesses. And frankly, now many industries are quite far down that route of digitization and sort of network effects and software adoption. And I think it's pushing innovation and entrepreneurial activity down a different path, one which increasingly fuses hardware and software capabilities. And it's one that's about making hardware devices, not just generating code. And I think we've seen that in a number of our bigger holdings in the portfolio. Arguably our two most successful businesses were sort of early adopters of this. You could argue Tesla with its automation and full self-driving, Dexcom with the algos to decode the glucose signal from blood. Maybe if you think about some of our current holdings, big holdings for us like Axon, the digital capabilities now embedded into the taser device and the body-worn cameras used by police forces, creating of digital files, analysis of those files, auto-generated transcripts, interrogation of number plates, suggested actions potentially for police officers, and building virtual training modules. These are all things that when you bundle hardware and software. I've touched on SpaceX, they're clearly a leader in that. Again, I've touched on Nanopore. They use very advanced software to decode the electrical signal as the DNA feeds through the nanopore on the device. And I think for me, this is it's more than just observations around companies doing this, because I think increasingly it's this combination of skills where businesses build their competitive advantage. But mastery of multiple domains is hard, and it's less about that sort of past 20 years of first mover advantage counting hugely, and it's more about who's best, who's really good at engineering, who's really good at doing that across multiple domains and integrating hardware and software. And it also opens up, I think, different monetization routes. It's not that old hardware model of sell something once and be done with it. These are now recurring revenue opportunities and hardware models learning from the software industry and that whole rise of software as a service.
Okay. And are there any other developments on the horizon for the rest of the year that you're giving particular attention to?
Yeah, another big private company for us might be worth touching on, again, active in that sort of hardware and software interface, a company called PsiQuantum, one of the leaders in quantum computing, one that we think has the most sort of credibility at building a scalable, workable quantum computer. And I think while some of your listeners may be sort of very familiar with classic computing and transistors and frankly some of the limitations around that, Moore's law reaching aspects of its limit. And again, when you now see some of these artificial intelligence algorithms, they almost max out in terms of the computational power that you can put towards them. And I think quantum computing might be the next leap to really bust through some of these constraints. So computing not based around sort of binary transistors, but qubits, where you can hold in multiple states. And it's almost analogous to classic on-off light switches versus digital dimmer switches. And that ability to have things in multiple states is more appropriate for when you want to do aspects of real-world scenario modeling. Hugely complex weather patterns, how proteins fold, building unbreakable encryption systems, supporting algorithms that could go well beyond what conventional GPUs can do. Why PsiQuantum? Well, I think that there are several players in quantum computing, but they all tend to be obsessed with building the perfect qubit, use a plethora of exotic materials and frankly, really extreme conditions to try and do that. PsiQuantum is unique, we think, and it starts with a known scalable technologies, optics and light and photons, and the way that controls them on an understandable silicon chip. And in doing that, they get to build upon pre-existing scaling blocks, understanding sort of 50 years and cost efficiencies of the semiconductor industry, and tweaking those things to make them quantum. And we've been very impressed with the progress so far. It's being championed by DARPA in the US, the Defense Funding Agency. They really recognize the importance of scalable, error-corrected quantum computing. And the company talk about having one of these delivered within the 5-year period.
Of the three things you've spoken about, tech innovation, operational performance, and the valuation opportunity, which do you think will have the greatest impact on long-term performance?
I guess the valuation correction over the past couple of years, that gap that's opened up in markets between smaller companies and large companies, it's stark, frankly. And when you combine that with what we think is the robust operational progress, we think that creates a very interesting start point. But a strategy like this, it's all about capturing the opportunities presented by that long-run innovation cycle, human ingenuity, breaking new technologies through and building businesses around them. And based on what we see, as I've sort of alluded to, we think that's so alive. I think we've touched on many aspects of that today, how that could change healthcare, communications, computing, automation, and much of this change is it's unaffected by the things that are influencing equity markets and then frankly been influencing the trust. It's not driven by tighter funding environments. It's driven by structural shifts, new combinations of technologies, and these things are underway, and these things will deliver on a sort of 5 to 10 year view. Many of the companies that we see with the potential to really deliver change, they are the ones the market is shunning. That feels wrong. The market is reflexively punishing early stage, pre-profitable businesses, almost regardless of what the opportunity set is for those companies. That feels wrong. And as a sort of long-term growth orientated investor, and having done this for sort of 15 years, it's quite weird to almost find what we do being treated in such a contrarian fashion.
People have held Edinburgh Worldwide for a good long time, say 10 years or so, witnessed a phenomenal increase in the share price, and then they've seen the opposite. And so there's a question really frequently being asked is, do you see a substantial recovery in the share price in the medium term, i.e. 3 to 5 years?
Yeah. I guess I've sort of hopefully hit upon aspects of that as we've gone through, but I'd almost say in that sort of near to medium term, what has really hit the trust over the last couple of years is this inflationary shock and the interest rate environment. And we invest in companies which are all about the generation of future cash flows. And the way people value businesses in the equity world is they apply a discount rate to those cash flows. And in that interest rate environment, people have taken aggressive haircuts to the value of future cash flows of these companies. How much do you take that current environment and say, well, that will persist forever? For me, that feels harsh. I'd echo my points around it being a very punitive environment for these types of companies. It feels like many of the drivers of that inflation are exiting the arena. And some of the elements that are still promoting inflation are arguably linked with higher interest rates. And look, there is an element here of central banks. They will be desperate to establish credibility, having been a little bit slow on the uptake and spotting that inflation. So that will come through, and these things will wash out, and that environment will shift. And it's not just the valuing of these cash flows. I think that the thing that we've seen is there's almost this total cataclysmic fall off in how people think about businesses beyond a 18, 24-month timeline. And for me, it'll be this normalization around how people project out and they think about long-term businesses. So that's the sort of the near to medium term, and in that medium term to long term, I'd echo what I was saying around just what we see coming down that innovation pipeline, it exists like it hasn't done before, and that will be the big driver in the long term. So hopefully that answers aspects of that.
It certainly does. And so there's this huge macroeconomic sort of headwind pressure down on the holdings. But just to clarify, that one viewer is asking, were there any significant changes in the portfolio sort of at the top of the market or before the recent decline? Were a significant amount of new holdings added that changed the risk profile, or is it all a result of this macroeconomic pressures that you've just described?
Yeah, okay. Detail on that will be in all the annual reports, and where we document things that we've done, what we've moved on from, and what we've added. But to keep it at a pretty high level, we are a low turnover strategy. We are not radically pivoting the trust based on a near-term view of markets. We own about 100 companies, and the historical pattern has been between sort of 5 to 15 new ideas a year. So yes, we did put some new ideas in, but it was certainly not out with that normal pace of idea generation. And the big things that we used to fund that were moving on from some of the companies that for us had delivered over that sort of preceding decade. The Tesla would probably be the biggest one that would resonate with people. So there's always an element of us recycling capital back into early ideas. That's where we think we have an analytical opportunity, and frankly at the moment almost like a stock market opportunity, because that's where people aren't paying attention. We did various bits of sort of technical analysis that would look at our portfolio back in almost like 1 year into COVID. What was there anything that we could have radically done to reposition the portfolio? Stay true to what we do, but reposition the portfolio. And the lessons there were not really. It's been this sort of suppressive effect across multiple of our businesses, largely as a result of that interest rate environment.
Okay, and actually on that, I've got a question about the board of the investment trust was sort of involved with you, talking to you about it during that sort of review. Yeah, what are you doing to restore the board's and shareholders' confidence? You've touched on it already, but maybe say a bit more.
Yeah, I think we have an annual strategy meeting with the board every year. We pose various topics for them. We explore how the trust has performed, things that we could do. Thematic elements within the trust, and the thing that we were keen to explore was around whether things that we were getting, less than optimal in terms of holding sizes, either at the top end or the bottom end of the portfolio. And we did lots of analysis, which is probably like beyond to go into the detail of it here, but it basically flagged that there was a challenge around holding things in the tail of the portfolio for a bit too long, just sort of consuming capital in an inefficient way. And there was maybe this little bit of a signal in businesses that we'd done really well in. And by that, I'm talking about we'd made maybe 2 times, 3 times our money. This was getting to a bigger position in the trust. Frankly, there was probably a little bit of feel-good factor around that because our hypothesis was working. And there was maybe a signal around, well, some businesses, yes, they do kick on from that. They do become the Teslas, the Dexcons. But there's also some that frankly, that's as good as it gets. And it's differentiating between the really special and the good. And we've tried to instigate processes into what we do that are better tuned to filter out those things.
Okay. Talking about the sort of selling side, selling discipline, do you use stopping algorithms? Does Douglas use any of these stopping algorithms to see stock in Edinburgh Worldwide or the open-end fund he manages? He's just wondering, do you use is there some kind of scientific basis to the way you sell stocks?
I think the gist of that question would be around sort of stop loss mechanisms and almost like mechanical trigger points that would kind of force an exit just because the stock price is telling you you're getting it wrong.
I think that's right. Is that part of your approach?
It's not. No, I mean we do track the performance of the companies, but I think if you overweight your process to taking cues just from stock prices, you fall into the trap of trying to be the market, frankly. And the market, as I've tried to hint going through this, it's riddled with inefficiencies, but both analytically and time horizon related. It's horrendously inefficient, and that inefficiency balloons out massively when you come down the market cap scale. So I think to take your action cues around price signals is dangerous, frankly. Now it can be a little bit of a prompt as to look, okay, the market's telling us we're getting this wrong. Are we getting it wrong? Let's delve deeper into what the reasons for angst are. But linking direct actions to declines in prices, for me, feels very dangerous.
Okay, thank you, Douglas. As I said earlier, there's a couple of questions around how Edinburgh Worldwide compares to some of the other investment trusts at Baillie Gifford. So specifically, you've got viewers asking, how similar is Edinburgh Worldwide to Scottish Mortgage, and also to Keystone Positive Change? What would your answer be?
Well, I guess the clear differentiator for us is we are much more active lower down the market cap scale. So for us, our typical idea would be around sort of $500 million up to maybe sort of 2 to 3 billion. That's the analytical sweet spot for where we put our ideas in. I'm less in touch with exactly where the market cap limits are for those specific trusts that were mentioned, but generally they will be, the majority of their ideas will be entered above those market cap guidelines. But they are global trusts. They are all global. They are all growth orientated. Keystone has the sort of the dual remit of the ESG entered into it as well. The actual idea overlap with Scottish Mortgage at the moment, it's mostly on the private companies side, and SpaceX would be the biggest one within that. On the listed side, it's relatively low. I think there's, we've seen this pattern, I think, across a lot of asset managers that, I think a lot of people have paid less attention to the small and mid cap area in this sort of more uncertain economic environment, interest rate environment. It's been easy to be a bit more dismissive, frankly, of early stage businesses. So I don't think that's just a Baillie Gifford effect. I think across the market, dedicated small cap money has been largely ignored by other investors.
Okay. Oh, talking of the private companies, we've got a question here from one viewer. She asked, how do you identify private companies you invest in? So maybe perhaps you say how many you hold and what proportion of the fund they make up at the moment.
Yeah, I wouldn't say it's that pure sort of where does the seed of the idea come from. It tends not to be that radically different from the listed side. It's being informed and interested around areas of change. Now, I guess there are quirks around the private company side, is that it can tend to be a little bit more inbound as to when particular companies are raising money. And I think Baillie Gifford, it's well positioned to be on the radar list of interesting up and coming companies needing growth capital. We have a dedicated private companies team in Baillie Gifford. We also have lots of investors like myself that will sort of traverse both worlds of, mostly listed, but occasionally dabbling in private companies. But a good idea is a good idea. And we've got 100 plus investors across Baillie Gifford, all looking for interesting businesses. So there's an internal network, an external network, and various ideas get worked up accordingly so.
Okay, thank you. Couple of questions on sort of specific investment areas. So what are your suggestions or interest in generative AI?
I touched on that a little bit in the context of the meeting. So you are really in the early stages of a profound technological landscape shift here. I do kind of get that. And at the moment, the stock market, it's alive to that, but there are limited ways in which to play it, frankly. And I touched on that with aspects of this sort of Magnificent Seven, the flood of money into businesses, which are just immediate beneficiaries of that. But as I sort of alluded to in time, it's how companies use this, how they adapt to it. we've seen that with CyberArk, frankly, which a business is about privileged account management in the cybersecurity space. And all of a sudden, you've entered this realm where computers can now impersonate people and launch hacking attacks in a way that feels incredibly credible to people that are on the receiving end of them. So companies are having to massively build up their firewalls and protection to guard against that. Again, that's a kind of second beneficiary of that. But there's a lot of companies that I suggested. Appian was one that we're very interested in, which is helping companies navigate this new world of AI, because it's one, yes, it's a big topic in investment. It's a big topic in sort of technology departments in big businesses. But most people in companies aren't technologists. They need to be shown how to use this, understand how to use this, have it curated in a way that can actually solve problems relevant for them. And that's where the business and the service opportunities we think will increasingly come.
Okay, thanks, Douglas. Right, so last question. Do you see any merit in investing in carbon capture systems or carbon removal technology in general?
We've looked, I'm a little bit out of touch with exactly where that is, but we have looked at a couple over the years, largely on the private companies side. There's limited, to my knowledge, sort of listed exposure to that. I think the initial take was, yes, you might be able to technically do this. Can you do this in a way that is economically viable? In terms of the ideas that we've come up with as a team, we've seen, I think, more interesting opportunities, and frankly, these would be nearer term opportunities around battery technology and fuel cells. But yeah, ultimately, carbon capture, if people manage to solve it and solve it in a way that can be done at scale and can be done economically, that would be hugely of interest, and I would envisage very sort of receptive to an investor community.
Okay, one to look out for, perhaps. All right, well, I'm afraid that's all we've got time for, but thank you, Douglas, for your time, and thank you so much for all your questions. I hope that what you've heard has proved helpful insight into Edinburgh Worldwide and some reassurance for its prospects going forward. If you'd like a further update, the Trust is holding its annual general meeting at midday on Tuesday, the 5th of March. If you're a shareholder, you're welcome to attend or view proceedings remotely via a video link. But in the meantime, thank you very much and goodbye.